Good day, Market Chameleons, everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon webinar series. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinars and shows, are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer. Let's welcome Dimitri Pargamonik to the stage. We'll be talking about options, time, and sales. How you doing, D?
Good morning, Lou. How are you?
Great. Let me bring your screen up. It looks like it may not be on. There it is. All right, perfect. All right, and there we go.
Yep. Good morning, everyone. And what we'll do today is take a look at options, time, and sales. And well, I think there's background noise.
All right. Sorry about
We'll take a look at the options, time, and sales, and just discuss what it is, what type of insights we could get from option transactions on a more granular level. So let's use an example. I'll go to Google, type in Google here, go to the Google main page. Once we land on here, what we'll do is go to the option chain. So on the left-hand side, we'll click options, option chain. This will bring up Google's option chain. I'm going to click on this menu to minimize it for now, expand our screen. And when we look at a symbol or stock that has options available for trading, then this option volume kind of gets aggregated into this one big number. Like here, option volume 230,000 contracts. 230,924 contracts. Well, options themselves, we have different expirations, we have different strikes, we have calls, we have puts. So then the question becomes, how do we dig deeper into this volume number and analyze it on a more granular level? Were there mostly calls? Were there mostly puts? Were they mostly in one expiration? Then once you get that part, you could keep drilling into the individual option, right? Well, how much volume was in a particular option? So this is kind of like how we go down the line. Here are the different expirations available for trading, and here are the volumes. 110,853 contracts in this expiration, 29,698 contracts in this expiration. So once we click on an expiration, let's say this one, 29,698, we get the option expiration over here with all these different strikes, calls, puts, and you could see different volumes for each contract. So if we go over here, let's say the 300 call, the 300 strike on the left-hand side are the calls. 995 contracts traded in that particular call option. If we go to the right-hand side, 944 option contracts traded in the 300 puts. Well, now we have that volume. We could dig in deeper and say, well, out of this 995 contracts, if I click on it, we're going to see more details, because how did they trade and what happened, right? So we got 995 contracts. That's the volume. But how did we get there? Was it one big trade, 995 contracts? Was it two different trades? Was it many different trades? And when did it happen? Did it happen throughout the day? Is there continuously order flow coming in? Was it one trade in the very beginning, in the very end? What were the circumstances? So all this is going deeper into the analysis, so we could get those important insights to make our own trading decisions. or to just understand the market dynamics. So we could see here, this here is the time in sales, where we have the time, the trade, and then details. So this is one contract traded at 3:57:41 p.m. Eastern, excuse me, Eastern time. The price, he traded as $6.75. So the notional would be, that's just a calculated value where we're taking, how much would that cost? It costs $675 because one contract represents 100 shares, $6.75 times 100, 675. Well, we could also add other details. What about the surrounding data, such as what was at that moment, the best bid and offer? So when we think of trades, we could also think of, well, markets are firm bid and offers. So if somebody's displaying a bid for $6.75, as we see here, well, at that time, that person would be obligated to buy, whoever sells it to them, they're obligated to buy it at $6.75 for whatever quantity they displayed. If you said, I'll buy one for $6.75, well, if you don't cancel it, somebody sells it to you, you're obligated to buy it, right? It's a firm bid. So once you put in a limit order, if you don't cancel it and somebody sells it to you, you're obligated to buy it. So these are the bids and offers at the time. $6.75, $6.80 was the best offer. So we could see here, if we just had to look at the trade, well, it equaled the bid price. We could also add more detail, but these are derived analytics. Well, what was the implied volatility of this option based on the trade? So if we took the trade, what was the implied volatility, and where was the stop price at the time, right? We have, where did the option trade, which exchange, because we have different exchanges. So what exchange did it trade on? And that could become important too if you're looking for where there's liquidity or lots of trading going on, maybe a particular exchange, maybe there's limit orders on particular exchanges. So we also have the exchange. And also, how did it trade? What was the condition? This was an auto execution. It was electronically executed, but you could have a multi-leg trade. This here trade involved another leg to the trade. So could have been a call spread, put spread. So we'd have to analyze that further, which is a different tool, intermarket sweep. So this gives us all this granular details that we could go and just scroll back and look at the sequence of the trades. If any bigger trades, or are they all small trades? Are they all clustered around a certain time of day? Are they coming in continuously throughout the day? This is what the time and sales helps us do, right? Go in there and analyze it further. And then once we get this, we could create all kinds of different aggregated analytics around it. Like we see that there are 294 trades reported for total volume of 995. Total dollar value of all the trades were 640,050. The open interest at the start of day was 1,923. We could also take a VWAP price, the volume weighted average price of all the trades. So this gives us not just the average price, but weighted by volume. So if there's any like really big trade, that one would get much more volume weight in this average. Then we could see the range, the high and low of the prices and the last. And we could do the same thing with the implied volatility. Right? What was the average volatility weighted by volume? What was the highest implied volatility, the lowest, the last? So this gives us a reference price for price discovery, right? Well, where is the bulk of the trading happening in relative terms, or happen in relative terms? If we converted it to implied vol, because the stock's moving around. So the prices are going to move around too. And the option pricing model helps us convert those trades into implied volatility. Okay, so the implied volatility takes into account the relative value, at the time of the trade. Then we could also compare, well, here's the average VWAP, price of the implied vol. How does that compare to the last market? So we can see here, this is the market from yesterday, December 17th to December 18th. So we could see how the market changed from one day to the other. So we see the price increased, right? The bid was 430, 435. Then it went to 660, 670. But we could also see that the implied volatility, you could see the bid 27.7 went to 26.4. Same thing on the offer, 27.9 to 26.9. So here we have the summary. The stock increased, the implied volatility decreased on this option, but the price did increase because of the delta, right? If the stock's going up, and it's a call option, there was a delta, the call option did go up, but in relative terms in implied volatility, that decreased, right? So there's some premium taken out to implied volatility. And we could see here that on average, the weighted average implied vol trading was at 25.29, but the implied vol did tick up from there to 26.4, right? So it was trading at a lower IV at some point, and the markets ticked up from there. Okay, so these are all important granular insights into the trading activity going to a specific option contract. And that time and sales helps us do that type of analysis. Will, I'm going to throw it back to you at this point.
Great job, D, as always, my friend. Thanks for bringing these webinars to the Chameleon community, and you have a good weekend.
Thanks. You too, Will. Thanks, everyone, for joining. Stay safe out there. Have a great trading day. We hope to see you Monday.
All right. Great job, D. Thank you, buddy. Bye. Hey, everyone. Thanks for joining another Market Chameleon webinar. Remember to like and follow us on all the social platforms. Look out for the weekend webinar series. There'll be one going out on Saturday and one on Sunday. So everyone enjoy those and have a great weekend, and get ready for the holidays. Bye-bye.